Hi, everybody. We are very keen to get started on time, so I'm just going to jump in. So good afternoon, and thank you for joining us today. My name is Aisling, and I'm part of the research team here at StuRents. Before I hand over to Richard, there's just a few bits of housekeeping that we want to take care of. Firstly, this webinar is being recorded, just so everyone knows, and the recording will be available to people afterwards at request. Secondly, we're running this webinar to coincide with the release of our 2022 annual report, and a copy of that will be made available to everyone on the call in the coming days. In addition to that, I'm sure many of you are planning to attend Property Week Student Accommodation Conference next Wednesday, and you'll be very excited to hear that Richard is also speaking at that. His presentation will be at 11:45 via the Stream 2 option. I'm hoping as many of you as possible will join us there as well. Today we are joined by leading industry experts, and we'll be continuing the discussion after Richard's data presentation, and hopefully if you have any questions, there's a Q&A option, and they'll be answering some of those. So we're going to try and get through as many questions as we can at the end of the call, but first of all we'd like to introduce our panel. So if everyone on the panel is just going to give a brief introduction, and Guy, if we could start with you, that would be great.
Hi, yeah, I'm a lending director at Pluto Finance. We typically do loans for student accommodation, either acquisition, development, or investment financing.
Brilliant, thanks. And Lee, if you could give a brief intro.
Good afternoon, everyone. Lee Layton from Colliers. I head up operational real estate research, sort of embedded within our operational capital markets team. We're a team of about 20, pretty much 2 years old now. So yeah, going great.
That's great, thanks. And Kevin?
Hi, good afternoon, everyone. I'm Kevin Dickens, CEO of Cloud Student Homes. We're an operator for around 4,000 beds for building owners with different profiles, buildings from Newcastle to Canterbury and many locations in between.
Thanks. And finally, Neil.
I'm Neil Young. Hello, everyone. Chairman of We Are Kin. We are a HMO owner and operator, operating in 6 cities at the moment, with about 1,000 beds. And we have a mission to create homes that build great memories of student life.
That's great. Thanks, Neil. And we all really look forward to hearing your opinions and hopefully tackling some pertinent questions after Richard's data presentation. And on that note, it's my pleasure now to hand over to Richard to run through some of the data today.
Thanks, Aisling. So if you bear me 2 seconds, I will just share my screen and we'll go through today's presentation. Right, so hopefully everyone can see that okay. By way of a kind of very quick introduction, just to appreciate most are familiar with us on this call, but there might be some that are not. So in terms of StuRents, we are the UK's only end-to-end student accommodation ecosystem, consisting of StuRents.com, which is the largest dedicated student platform in the UK. We also have our own in-house proprietary property management software that's being used by both HMO agents and PBS operators as well. And then we obviously have our data intelligence services as well. Since actually our inception in 2008, the ecosystem has generated over 100 million data points on the market, and our property management software has executed around 1.7 billion in tenancy value. In terms of the topics that we'll be covering today, we're going to start off with a kind of a quick recap covering demand as well as supply. We'll then dive into the pipeline in a bit more detail. We'll then move on to look at occupancy and how that is changing, and also how that feeds into rental growth. We'll do a very quick summary, and then as Aisling's already alluded to, we'll then go on to a further conversation with the panelists and answer some of those questions at the end of the session. So to start with, let's do a very quick recap covering demand. So the chart on the right depicts the number of full-time students in the UK over time. And what we can see from the data is that between 2010 and 2020, total full-time students have grown by about 25% roughly to approximately 2.1 million students. What is interesting to note regarding those figures is actually the pace of growth, which has actually increased in recent years. So if we look at 2020, for example, again, full-time student numbers jumped by about 7.5% year on year, which is actually an increase in terms of that rate of growth compared to the previous year when it was at 3.9%. In terms of demand for accommodation, StuRents estimates there are around about 1.5 million students actually requiring a bed. And obviously the difference between those two figures is the number of students that stay at home whilst they're studying. In terms of the latest demand data, what we've also done is looked at the latest UCAS stats, which go up to actually the 2022 cycle. And actually looking at those figures, particularly focusing on acceptances, those are actually somewhat surprisingly down slightly year on year, so down by 1% year on year. But actually, if we compare those acceptances to the last pre-COVID year, so we're looking at 2019 really, then actually they are up by 1.4%. In terms of the fall for 2022, again, referring to those UCAS stats, that was primarily attributed to a decline in actually acceptances of more mature students, as well as EU students, which have continued to fall essentially post-Brexit. For the PBSA market, those UCAS acceptances are actually up, so up by about 9.5%, which is obviously great to see. In terms of performance across universities, what we really wanted to do during the session is highlight how this differs massively between locations as well as each individual university. So whilst, again, nationally the outlook and historical numbers have looked very favourable, if we actually dive into individual institutions, we can start to appreciate how, again, they do differ. So we've just taken a selection of universities on the right-hand side and essentially depicted how full-time student numbers at those institutions has grown or fallen since 2010. Starting with York St John University as an example, we can see from the data that full-time student numbers there are actually up by 75% since 2010, so a huge increase. If we look at the other end of the scale, we can see it again via that chart on the right, and take London Met as an example. Those numbers have actually started to recover, but they are still down by about 32% compared to 2010. Generally speaking, Russell Group universities have outperformed the sector, and full-time student numbers at Russell Group institutions are up by about 36% between 2010 and 2020. And that compares to growth at all other institutions of about 21%. So again, those Russell Group have outperformed. There is a risk of generalising. Obviously, there are going to be universities that are maybe outside of Russell Group that have performed particularly well, but on the whole, that trend is obviously accurate. In terms of some other interesting trends that we've really looked at, particularly in the annual report, is around postgraduate growth. And actually what we saw, particularly for 2020, is actually some of those, what you might want to classify as less prestigious universities, have done particularly well with postgrad recruitment. If we take University of Hertfordshire as an example, what we actually saw is that postgrad numbers were up by more than 350% in 2020 compared to 2015. And that's equivalent to about 5,000 additional students. So again, performance is very, very mixed between universities. Obviously, some universities, again, have performed well from a postgrad perspective. Outside of the HESA and UCAS data, we've also obviously looked at data around student issues, visas, and what we can really see from the chart is how they have grown over time. And we've just isolated visas issued to either Chinese students or Indian students since 2010. And looking at the numbers, what we can see there is that in Q3 last year, there were 164% more visas issued to Chinese students than in the same period of 2010. So a huge increase over that period. What we can also see from the chart, and it's highlighted there, is the impact of COVID. So we saw a dramatic drop-off in those visas being issued, and that's going to be attributed to essentially students that are unable to or perhaps unwilling to travel during the height of COVID and then simply did not travel to the UK. And obviously that was partly reflected in occupancy, particularly of PBSA and some of the markets that were more exposed to international students. It's also worth noting Indian growth, which again is becoming more important. And again, a huge increase, actually more than 100% since 2010. Looking at demand between accommodation types, so the chart on the right depicts the distribution of inquiries over the course of the season that has just finished, either for PBSA or HMO. If we start with the HMO sector, what we can essentially see from the data in that particular chart is that demand for HMOs really peaked in November, which is very early, but not unexpected. And if we look at the data, we can see there that around 70% of all the inquiries generated for HMOs over the course of the year are done so by March. So again, it's a very early market. If we compare that to the PBSA sector, it's essentially the opposite of that. And we can see essentially that demand for PBSA was much, much later in the cycle. And by March, we're looking at around 24% of inquiries were made. So again, highlighting the point that demand for that type of accommodation is very much skewed to the back end of the season. Again, that is pretty much as expected, and actually it's less extreme than what we saw last year. So last year, the peak for PBSA was actually later, and that was again attributed to the fact that a lot of international students either were delaying their accommodation choices, or perhaps couldn't travel, and again that led to a more dramatic skew to the back end. In terms of inquiries across accommodation types, so again for the season that's just essentially finished, we're looking at an average inquired price for HMOs outside of London of £132 per person per week, and for PBSA you're looking at about £170. So a pretty big difference, but again that's going to be driven by underlying core demographics that are advertised for that type of accommodation, and obviously the difference in price points as well. Moving on to look at supply in a bit more detail. So as of the 2022 season, again just finished, we're looking at total PBSA supply nationally of about 717,000 beds roughly, and the vast majority, or over 50%, so actually 53% of those are actually managed now by private operators. In terms of growth over the long term, what we've essentially seen is that since 2016, there have been more than 150,000 new PBSA beds added to the market. And again, the majority of those have been added by private operators. In the HMO market, it's very difficult to get truly accurate numbers around bed counts. But what we have looked at is various data sources. So, for example, looking at demand for accommodation relative to the supply of PBSA, also looking at things like council tax exemptions and how those have changed over time. And we estimate that actually the HMO market has grown, or non-PBSA is probably the best way to categorize it, has grown by about 200,000 beds since 2016. And that probably goes against some of the messaging in the market. But again, the data definitely points to actually an increase. And from the chart on the right-hand side, we can see that, again, we're looking at about 59% of all beds in the market are actually provided by the HMO sector. Looking ahead, and if we look at the pipeline in particular, particularly around PBSA, again, the majority of that pipeline is skewed to private operators. So the market really is going to be increasingly reliant on private operators, either in the HMO market or in the PBSA market, to accommodate students. And that means that the proportion of beds provided by universities is actually going to continue to decline over the long term. In terms of PBSA growth and how that has varied this year versus in previous years, the chart on the right shows the percentage increase as well as the number of beds that were delivered each year. And for, again, the season just finished, we are looking at about 17,000 beds delivered, and about 2.5% increase in supply of PBSA year on year. As we can see from the chart, that very much is slower than what we've seen in previous years. And if we look at the data for 2019 as an example, we were looking more along the lines of 37,000 beds added and growth of about 6% roughly. So again, the delivery of new beds in the PBSA market has definitely slowed. In terms of those that were delivered for this year, as I've already mentioned, the vast majority, so over 80% of those were delivered from private operators. In terms of how these numbers may change going forward, if we look at the existing pipeline, for example, whilst the pace of growth could increase, albeit there are, whether it's construction headwinds or financing headwinds, and I'm sure we'll cover some of those a little bit later, we wouldn't expect the pace of growth to repeat what we saw in 2019. And therefore, again, supply growth is going to remain relatively low by historical standards. As we've already mentioned, though, there are big differences between locations. So in this particular chart, we really just wanted to highlight that, and again, just highlighting a number of locations there to show how they do differ. If we could look at London, for example, whilst thousands of beds were delivered in that city, we're looking at supply growth of less than 5% year on year. If we look at somewhere like Swansea, we're looking at supply growth, again, just in the PBSA market, of around 20% year on year, albeit from a relatively low base. So again, whilst nationally supply has grown not by very much at all, really, again, each individual location will differ. And in somewhere like Swansea, we're talking, again, about 20% increase year on year. And this really highlights the point that the market is much more nuanced than what the national story tells you, and therefore actually in terms of supply and demand growth, as we've seen in Swansea and other locations, it's worth noting that that supply growth is not necessarily being matched by demand growth. And again, we'll explore that in a bit more detail shortly. Moving on to the pipeline, just to explore that in a bit more detail. So going back to that previous point that I mentioned, what this chart is depicting is planning activity. So either beds submitted or beds approved. And whilst the pipeline currently stands at roughly 113,000 beds, what the chart does show us on the right-hand side is how that activity has slowed over the long term. So if we look at that data, and we've just picked out two different periods here. So in the first 9 months of 2018, for example, we were looking at about 42,000 beds submitted and about 35,000 beds approved. If we obviously fast forward to 2022 and that same period, we're looking at about 19,000 submitted and about 18,000 approved. So again, activity on the whole is very low compared to historical standards. But again, highlighting the point that this does differ per location. If we look at somewhere like Nottingham, which has been a very active market from a planning perspective, we're looking at more than 2,000 beds submitted in the first 9 months of this year. Whereas in Cardiff, and Cardiff's is recovering, but certainly was a market that has struggled with oversupply of PBSA, we're looking at almost zero, so less than 100 new beds submitted in the first 9 months. So again, very different in terms of activity between those two locations in particular. Looking at unit mix, what this basically shows us is what the pipeline consists of. And the vast majority of beds in the pipeline consist of studio units, so about 41%. And what that basically tells us is the market really is continuing to focus on international demand, which are the primary target market for those studios. In comparison, if we look at the domestic market, and domestic students on average are looking for 4-bed clusters or HMOs, we can see from the pipeline that less than 5% of beds in the pipeline are of that size. And that does somewhat suggest that domestic students, not that they're being ignored, but certainly the preferred room types are not being delivered in the quantities that are needed for that domestic demand, particularly in the PBSA market. Again, just highlighting a few differences between locations, and this shows the size of the pipeline. If we look at Nottingham, so Nottingham has the largest pipeline outside of London, around 11,000 beds. Glasgow is an interesting one. Again, it's been well reported in recent weeks about the difficulties in terms of undersupplying Glasgow, and it actually has a relatively small pipeline, around 1,500 beds. And in Newcastle, a market again similar to Cardiff, but perhaps struggled with oversupply. Again, very little pipeline. So again, that does differ dramatically per location. Moving on to occupancy. So an initiative that we have started here at StuRents is actually to gain occupancy data from market stakeholders, and participants are able to then leverage that data in a timely manner to help things like marketing decisions. What we wanted to do is just show you how that data differs between two different locations, in this case, Coventry and Exeter. And what we can see on the right-hand side is essentially booking velocity or occupancy for the season just finished between those two locations, actually then split by room types as well. If we look at Exeter to start with, we can see that by September, the market was largely sold out. So you're looking at 99% of studios sold and about 95% of clusters. And if we compare that to Coventry, immediately we can see the cycle was a lot later. But actually what we can also see is that studios have performed relatively well. And in September, you're looking about 90% booked. Whereas for clusters, that stood at less than 70%. So again, very different in terms of locations, but also actually accommodation type as well. And what we basically determine is that unit mix and location are obviously key drivers for performance, and getting those two factors right will help determine the likely success of a scheme. In terms of other implications as well, obviously if your booking cycle is later and maybe not performing as well as other locations, that can have a knock-on effect in terms of additional marketing spend, for example, to try and capture some of that market demand, essentially. Very quickly, just to touch on rents, and obviously occupancy is a key driver of that. What we saw, again, for the season just finished was that PBSA rents on a like-for-like basis at a national level were up by about 3.1%. But again, big differences between locations. So in Bristol, we're looking at essentially double digits, whereas in Sheffield, it's pretty much stagnant. And again, Sheffield is a market that has somewhat struggled in recent years. If we look at the HMO market, rental growth was slightly stronger, so just over 5%. And interestingly, in the HMO market in particular, what we have seen is some significant rental growth for the 2023 season. If we take Durham, which is a particularly early market there, we've seen HMO rents on average up by about 18%. And in some cases, we're seeing HMO rents up by 50% or more. So potentially very big increases in HMO rents for the 2023 season, albeit it's still relatively early days. Finally, just a quick slide on the outlook, essentially. And what we wanted to do here is, rather than focus on the picture at a national level, which for the most part is very bullish, again, we just wanted to highlight the differences between two locations. So starting with a positive market, and we picked Glasgow in this particular instance, what the chart on the right-hand side is showing us is what we would classify as core demand for PBSA. So this is the number of first-year students living away from home, as well as second and third year international students and international postgrad students. And essentially the chart depicts how that has changed over time, as well as a forecast for 2021 and 2022. And then we've compared against that changes in PBSA. Now, what the data shows us in the example of Glasgow, and this is again reflected in the news stories in recent weeks, is that core demand growth has really now outstripped changes to the PBSA supply. And that suggests Glasgow is going to remain or is undersupplied. And if we go back a few slides, again, the pipeline in Glasgow is relatively small. So we expect that location to remain positive for operators and investors, and perhaps challenging for students on the opposite side of that equation. If we take an opposite view, and then we've just picked out Sheffield as an example, what we can see is essentially the complete opposite to somewhere like Glasgow. So again, the chart on the right has depicted core demand growth versus PBSA supply growth over time. And what we can essentially see, which is highlighted by the grey area in this case, is the reliance of PBSA on second and third year domestic students. Now, the ability for the PBSA market to attract second and third year domestic students will very much depend on the location. But if we look at somewhere like Sheffield, the average HMO inquiry last year was less than £100. So again, if you are a PBSA operator in Sheffield that perhaps can't fill with international students, the ability to attract those second and third year domestic students out of the HMO market, where the inquiries are less than £100, is potentially going to be challenging. In other locations, it'll be less of an issue. But obviously that is an interesting point to note, essentially. To summarize really kind of key points from the data. So demand is definitely rising and continues to look very positive, whilst we have definitely seen a slowdown in the delivery of new beds as well as planning. And that means that macro fundamentals are going to remain very, very bullish, and that's for both HMOs and PBSA. However, as we've touched on a number of times, there are distinct differences between locations and even between universities, and therefore understanding the detail is going to allow you to better understand the likely success of a scheme or not. Obviously, those broad fundamentals whereby we have, at a national level at least, demand outstripping supply is going to potentially mean that accommodation is going to be increasingly unaffordable. And if we cast our mind back to Durham, for example, where we're seeing HMO rents, again, 18% up or more, that is not sustainable, obviously, in the long run. And obviously for domestic students, that could be particularly challenging from an affordability standpoint. And then lastly, just to reiterate, I wouldn't underestimate the role of the HMO market. Again, it's equates to about 58-59% of all beds in the sector. And understanding the HMO market really then allows you to better understand both opportunities as well as risks, even for PBSA operators. Last point just to note, and Aisling's already touched on this, so we will be presenting data at the Property Week conference next week in the Stream 2 session. So if you are around on the day, do come and take a look. There'll be a lot more data that we'll be running through during that session. And also, as I say, we're going to be sending out the 2022 annual report in the coming days. So again, do look out for that. At this stage, I'd like to hand it back to Aisling, and obviously the panelists that we have here today, we're going to run through some of your Q&As and essentially continue the discussion. So I'll stop sharing my screen, and Aisling, if you want to take back control, we'll go through some of the questions.
Yeah, thanks very much, Richard, and I'm sure everyone can agree that that was very interesting. And the insights that came out of that, if anyone does want to have a look back on it, everyone will be getting a recording of the webinar afterwards, just to confirm. But now on to what I'm sure most people will think is also the more interesting part, questions of our panelists. And the first one, I'm just going to dive straight in. First one is for you, Guy. And a lot has changed in the capital market since the mini budget in September. How has the financing landscape changed since then, and what implication has this had on new build development?
Thank you. So there's been a lot of changes in the financing markets over the past year. Financing costs, I'm sure you've all seen the news, they've gone up quite significantly. Bank of England base rate is now 3%, from close to 0%. Also, the SONIA swap rate, which is generally used in quite a lot of investment loans, has gone up from a long-term average of around 60 bips up to 400 bips. The start of the year was very busy. There was a lot of refinances happening to take advantage of rates while they were still low. Now what we're seeing is debt serviceability. It's been restricted, particularly for low yielding assets. That's because the finance costs have increased quite significantly, sometimes by over 50 to 75%. The assets which we've seen the lowest loan to values have been the low yielding assets. So typically London assets with yields in the 3%. It's very, very hard to get over 40 or 50% loan to value, as the income isn't sufficient to service the debt. So the leverages have had to come down. I'm still seeing quite a lot of liquidity in the lending markets, with banks still there, but being less aggressive than they were earlier on this year. Debt funds are still being fairly punchy in their terms, and confidence has come back into the market since the government U-turned on the mini budget, albeit rates are still significantly higher than they were earlier this year. The implications for new build developments is that the viability of schemes have been affected by these increases in finance costs, and over the past 12 months since the opening up of the pandemic, also construction costs have gone up. Albeit rents have gone up in quite a few locations to offset these increases. We're still seeing lower residual land values, particularly in the regions, sometimes at a negligible value. Also, over the past few months, we've seen a significant number of forward funders that seem to have hit the pause button for funding PBSA developments. We're still seeing quite a lot of viable schemes coming forward, particularly within London. This is because the land prices were high enough to give a little to make the scheme viable, given the increase in construction and finance costs. And again, high rents are helping to reduce the viability gap.
Okay, that's really interesting. And I'm wondering if, Lee, maybe you have anything to add from a yield standpoint?
Yeah, I mean, obviously, yields differ by product and location, but generally speaking, they tend to move down about 25 pips, possibly going out to 50. But as I say, a 25 pip movement on 3 is very different to a 25 pip movement on 6. So it does vary, but if we speak generally, we would go out to 25.
Okay, thanks, guys. And on a related note, Kevin, I'm wondering if you can comment on how rising utilities and financing costs have impacted your business, and maybe what you're doing to mitigate this and what impact it's had on student affordability.
Yeah, I think all of our building owners are obviously feeling the pressure on yields, and students feeling the pressure on potential rent increases. Obviously, the rent increases, the rents being paid now were signed up to some time ago, but everybody's just releasing their rates now for the 23-24 academic year. And I think that's we've just been doing our research and released our rates, and there is definitely going to be a significant increase, which is obvious and unexpected, I think, really. We were lucky enough to lock our utility rates in until September 23, but we're budgeting for a 30% increase thereafter, which probably represents a 5 to 10% increase in operating costs, depending on the building. That there's obviously been some staff cost increases as well, in addition to that. And to mitigate those factors, really, we're working hard on improving the energy efficiency of the buildings, trying to identify areas where we can reduce energy usage, educating the students on the energy usage, working on staff retention, finding more cost-effective contractors, and just refining our sales and marketing processes, really, to try and keep those buildings at 100% occupancy, as we have been for most of this year, despite the increases in the rents.
Yeah, that makes sense. And I'm wondering, Neil, if you could if there's anything to add from a HMO perspective.
Yeah, I mean, I think Kevin makes the point that a lot of our rents that we're benefiting from this year were set last year. So in the short term, the increase in costs and funding is having a negative impact, and we're all kind of having to suffer that. I think in terms of how do you mitigate, as has been said, we'll be realigning rents for the next academic year. We're doing a lot around the green initiatives, so smart controls, insulation, solar, which was something we were doing anyway, but I think we're probably going for that a lot quicker. And then in terms of growing the portfolio, we're going to have to see price adjustments in the same way as it's been mentioned that land is easing. I think for people to be selling some of the assets, they're going to have to be doing it at more competitive yields. Yeah,
I think that all makes a lot of sense. Then moving on to kind of a completely different topic, there's a question I think maybe Lee, you might be good to address, which is outside of China, are there any other countries where we can expect to see similar increases in student demand?
Yeah, I mean, just parking sort of the recent announcements from Rishi's government for a second. I think China's obviously the big one that we all focus on, and we tend to focus on household growth of the bracket of $200,000 US on a constant basis when we look at our forecasts, and And yes, China's the headline in that, in terms of, you know, massive amount of growth, 2.9 million households in by 2040. But you can't ignore India, as Rich pointed out earlier. You know, it's in ignoring numerical terms, in percentage terms, those households are growing at a faster rate in India, albeit from near enough nothing. We've got that at about 450,000 households by 2040, so that's significant. There's differences, obviously. You know, we've seen that in sort of mainstream residential markets, in terms of, you know, Indian families of that wealth are far more aware of what's in England, and so you won't see that translate directly into BBSA, but a lot of those households will want their children to be in safe, secure, and clean environments.
Yeah, of course. And then I'll start with you, Neil, but I think Kevin as well, you've got probably something to say on this. Can you comment on whether you are seeing your tenant profile change due to demand from other countries? For example, are you seeing more Indian students?
I mean, for the HMO market, and for our business that we're in, it's predominantly domestic students. And I think for us, more the change in profile is the fact that we tend to buy assets that need a considerable amount of work doing to them, and moving them to that kind of upper quartile. So we've seen a changeover, but still within the domestic market. As we get closer to the academic year, kind of late summer, as the visas come out, we do take some overseas, and we are seeing maybe an increase in Nigerians and Indians, but that's a fairly small sample size.
Thanks. And Kevin, the same, or?
Yeah, we've seen not really the same. I think we've seen an 11% increase in Indian students across our portfolio over the last couple of years. Again, as Rich mentioned earlier on, there are micro factors, in some areas increased more than others. Chinese students, we haven't seen a lot of variation, but we've also seen a nearly 7% increase in Nigerian students as well. So definitely a lot more variation for us than for Neil.
Yeah, I think it'd be interesting as well, maybe probably more related to Kevin. Obviously, we've looked at this data as well. We're going to be exploring it next week at Property Week. But the difference in particularly budgets between Indian students and Chinese students, and accommodation choices, in terms of, again, it's maybe too early in the cycle for this year, but are you seeing Indian students preferring clusters and at lower price points, or are you seeing demand for studios, or is it a bit of a mix?
Yeah, I think definitely lower price points for Indian and Nigerian students, much more so than the students from the Far East. The Far East definitely are more inclined to book the higher end properties in the studio accommodation than those other nationalities.
Yeah, I mean, that's definitely what we're seeing in the data as well.
Okay, yeah, and another good example of how we can't take the general rule to be applied everywhere. But looping back, we've had another question regarding some of the earlier stuff we're discussing, and I think Neil and Kevin, again, you might be best to answer this. How important is ESG for students? Are you noticing they are more concerned?
I think we'd like to feel they were.
Mm-hmm.
I mean, we had over the summer, we were doing some internal wall insulation, which obviously has, you know, impacts on the property, but students didn't seem that bothered about it. You know, we thought they see that as a positive for the homes that they're moving into. I'm not seeing it having as big an impact as maybe we'd like it to.
And do you think most of that's down to cost? I mean, again, if we're looking at particularly domestic search budgets, they are, some locations are definitely stretching those budgets, and I presume that is a main influencing factor there, in terms of they'd like to pay more maybe for a greener property, but just simply can't afford to.
I think it's I don't know if it's a desire to focus on maybe more the cosmetic side of the property rather than the environmental side, and I'm not sure it is necessarily a price thing, but I'm not sure if it's resonating yet enough, or as much as I think it will in time. I
think from our perspective, there's obviously, you'll always have those who are very keen. You'll have those who are not keen at all, and it's just trying to turn the heads of the bulk of them that are the middle ground, who are comparatively apathetic. And if we're working on having energy efficiency champions and things like that to try and just work through that across all students within the building.
That's really interesting, and hopefully that will change soon enough, because we should all obviously be having it as a priority. But again, doing a bit of a switch on topics, I'll start with you, Guy, but again, Lee, feel free to jump in. Are you seeing any locations that are particularly active from a development or acquisition perspective?
Yes, so I'm seeing quite a lot in London at the moment, particularly with office buildings on the fringe of the square mile, a location we typically haven't seen for student before, and not one that you could get planning consents for, but that's changed over the last 6 months or so, and also these quite a few fringe office buildings are coming up for vacant possession within the next year or two, which gives the developer time to get the planning permissions, and also seeing these buildings come at quite a discount to where they were just a few years ago. But that's generally the market I'm seeing quite active right now.
A bit of a non-answer, but I think generally speaking, from our guys that we talk with, if fundamentals stack up, they're very agnostic on area. Happy to be advised along those lines. So we're not seeing anyone stuck in their ways in terms of obviously there's businesses that focus on Russell Group, but generally speaking, investors are fairly open-minded, which is pretty refreshing.
Yeah, that's good. And then, just in the interest of time, this could be one of our last questions for Neil, actually. There are various headwinds in the HMO sector, whether it be rising cost or the renters reform paper. How do you see this impacting the HMO market, and will there remain a viable alternative to PBSA?
Yeah, I think there's three main headwinds at the moment. I think they've all got a slightly different timing to them. I think we've got, as we've mentioned, the kind of cost and funding in the short term or hitting us now. That's having one impact. I think the rent reform white paper is having a nervousness in the sector and a somewhat uncertainty over the timescales, but probably over the next year or so, we should have more clarity on that. So I think that's the next point. And then I think the third point, which is probably one that's not talked about as much, is the environmental side and the need to be an EPC C or above for new tenancies from 2025. And I think that one is possibly people aren't aware or people are ignoring it. But they're kind of three pieces that are having a negative impact and are already and will likely have a reduction in supply for the HMO market as people either sell out or look at using their properties in the wider PRS. And I think it's important that people are lobbying on the Rent Reform Act. I think it's important that the green works are done. I mean, education is one of the UK's great exports. And I think the sector sometimes is a bit one-eyed on PBSA and doesn't look at the importance of HMO. Richard and StuRents are very good at highlighting the importance of HMO and the fact that it's the majority of the sector. And the fact that the Rent Reform Act treats HMOs differently to PBSA, in my view, is wrong. I think they should work together. It's interesting in retail, people like Sainsbury's like having local independent retailers near them. And it seems odd because it takes business away, but they work together. And I think the sector should work together better. And, through the regulation that's come in on PBSA, some of that should come in for HMOs to improve that sector. So we can talk about it as an overall student accommodation sector.
Yeah, I think kind of on that point as well, actually, we're probably going to be exploring renters reform in our next webinar, probably in the new year. But we're starting to kind of get some feedback from Scottish agents, where that similar legislation came in a number of years ago. And it's the initial feedback we got is not being a complete bloodbath in terms of, whilst it's reported in the press of, HMOs leaving the market in droves, they're not necessarily seeing that. Again, I think there's still a lot of uncertainty around England in particular and how it might impact things, but yeah, certainly one we'll keep a close eye on for sure.
Well, thanks, guys. I think we are getting close on the time, so we understand if anyone needs to drop off, and obviously the webinar will be sent to you afterwards. But I think we do have time maybe just to address one more point on HMOs. And Rich, I think you are quite well aligned to answer this, which is there any data available that would cover the loss or estimated loss of HMO properties over the last couple of years?
Yeah, I guess it kind of comes back to Neil's point as well, and it's an interesting one because obviously we do go to the conferences and so on. It is typically argued that the HMO market is in decline. The problem is it's very difficult to quantify that. We have looked at things like council tax exemptions, so i.e. properties are fully occupied by students. We've also looked at data from HESA around term time accommodation. And what is interesting to know is actually when you look at that data from a national standpoint, it actually points in the opposite direction, where the number of properties, what I classified non-PBSA, has actually been rising. And that's very highly correlated actually to growth in domestic students, which logically I think makes sense. But it does vary. Again, if we look at certain locations, and we do highlight this again in the annual report, somewhere like Nottingham, for example, which has had huge growth in both UK and international students. Equally, we're seeing a lot of growth in the PBSA market and non-PBSA market, again, utilising some of those stats. Whereas you go to somewhere like a Plymouth or a Southampton, it appears to show the opposite. But I think that's very much the market reacting to declining demand, particularly in the domestic market. And again, if you're a HMO landlord that perhaps struggles to let your property because domestic students are declining, then it makes logical sense you'll maybe try and flip that for an alternative use. Whereas in the opposite way, Nottingham or Durham, for example, if you're renting your property very, very easily every single year, getting very good rental growth, it's not always easy to find more of that stock, but you're probably going to be inclined to do so. So yeah, as I say, it's very difficult to exact numbers because there is a lack of quality data on it. But the data that we have explored, again, from a national standpoint, actually points to an increase rather than a decline. Again, with the caveat that we are seeing falls in certain locations. I'm not sure, Neil, if you have anything to add to that, but I certainly
I think the point I'd add is that some of the comments I made there, for example, the Rent Reform Act, environmental, they're coming into the future. And also the tax changes have really started kicking in over the last year or two, where it's fully implemented, the change on the mortgage treatment. So I think we're starting to get that kind of perfect storm happening now, as opposed to a couple of years ago. And also, there's obviously a lot more Article 4s around as well, which is preventing new HMOs coming through. So I think maybe the last 5 years will be quite different to the next 5 years.
Yeah, thanks, Neil. And I think that's a great place to end our Q&A session. We've dealt with a fair few of the questions that were sent in, but if there are any outstanding, we'll try and be in contact over the next few days to answer them. So I think that just leaves me to say thank you to our panel, to Guy, Lee, Kevin and Neil for all your insights. Of course, to Richard for his data insights. And thank you to all the participants who joined the call today. We hope to see you all again soon, possibly at Rich's talk next week. And I hope you enjoy the rest of your afternoon.
Thanks, Aisling. Thanks, everybody.